I'm excited to welcome our first speaker, Juan Benet, the founder of Protocol Labs, an open source research and deployment org building next generation web technologies. He'll be discussing public goods for fun and profit, introducing some novel structures for public goods funding vehicles to make them more sustainable and scalable. Welcome, Juan.
Thank you very much. Super excited to be here today. I want to talk about something that a lot of us have been working at in Protocol Labs and in surrounding organizations. We think that this is a combination of valuable new ideas that can enable a lot of optimization around funding public goods. We think that the ideas that we're going to talk about today have a lot of potential, but this will be kind of long-term oriented potential. I want to kind of describe the idea behind network funds in detail. I want to kind of break down the why we think that this is an exciting opportunity. And then I want to spend a bit of time talking about and connecting it with other projects and other ideas that have been discussed across the funding public goods ecosystem, things like impact certificates, things like FROs, and so on. But I think the core thing that I want to get across today is just kind of the basic building blocks of why these network funds need to work this way to try and create a robust optimization landscape. Last one in the comments, I talked about the paradystopian long-term vision of trying to achieve some great outcomes by focusing on collaboration and coordination towards building scientific and technological impact and broadly diffusing that to the world. I talked about the innovation chasm, which is this bottlenecking area between producing new knowledge and then translating that knowledge into technology that we can use. This is where, from my studying of a set of problems, this is where most lags and problems exist when it comes to translating, to sort of improving the world, meaning across most fields in science and technology and so on, it's not a lack of ideas that is bottlenecking. It's rather the ideas getting translated into systems that can be broadly diffused to the world. And so the bottlenecks are not in producing new knowledge, but it's rather in how to translate the knowledge that we do have into something that is practical, usable, broadly marketable, and so on. So it's in kind of this area of the R&D pipeline that I think we need way more work and way more instruments. Now, of course, more funding and more work and so on needs to happen across the board, especially kind of in basic research and so on. But I think there's an especially bad problem here in the translation part. I also discussed and talked about how you can think of structures for investment funding in the sort of for-profit world when it comes to cash flows and building startups and so on. I talked about how there's a very robust funding staircase for projects of various different sizes when it comes to generating cash flows. So that means it is these days in 2022, if you can translate some project into a company form that is going to get some cash flow in the future, meaning it's going to sell some product in a market, and you have some cash flow that you can estimate and you can describe with some time horizon in the 5 to 10 year scale, then there is a very robust market of funders that can provide funding to you and help support you and help achieve that mission, all the way from kind of early stage funding and smaller scales to massive scales in the hundreds of millions to billions of dollars. And so most of the technological output that we have today sort of relies on this deep capital market that is that's very kind of continuous or the discrete steps are so many and it's so easy to go from one to another that is the lifetime of a startup is relatively easy compared to many other works. I talked about how one of the really important pieces here is that this market of capital has hundreds of thousands of actors, like of different parties that are making independent decisions that are trying to optimize the system, meaning that whenever they spot a hole in the market, whenever they think that you can do better, there's a frictionless path or a relatively low friction path for them to take bets about the future bet on some new technology startup, bet on some new company, and so on. And if they're right, if they're correct, they're going to profit from that. And that's a really key point. I'm going to return to this later on. And today, the world has in the order of tens of thousands of VCs. Now, of course, the really successful ones are probably in the tens to hundreds. Maybe some might argue like less than 10. I think it's more like in the many tens. But in reality, you have a very robust market with hundreds to thousands, or to even tens of thousands, depending on how you dial the knob of different companies dedicated to the practice of investing in startups, investing in technology companies, and so on. And part of what makes this all work is that at the end of the day, there's some public market that enables those investments to be realized into some kind of liquidity event that enables us early investors to profit from betting correctly about the future. I discussed last time that when you compare that to the public goods funding world, the funding staircase is not nearly as good. There's a lot more capital in the early parts, so the world is actually quite generous. The world donates a lot of money for lots of important causes and good works. But when you kind of start going up the staircase, it's way sparser. And in the upper ranges, there's only nation states. And even in those nation states, there's only a few organizations where if you don't fit their particular funding criteria or often like political views or often all kinds of other restrictions, then you won't quite have access to funding. And so this funding staircase is actually quite bad relative to the modern sort of capital markets for venture capital. And so I think that this is the area where if we can figure out some structures to fill in the gaps here in the middle and the upper ranges, then we can drastically improve the amount of public goods work that happens, and ideally align it with kind of whole world outcomes. Last time I also kind of talked about in the large scale, there is a lot of funding and a lot of capital going into these avenues, but it's not well diffused, and a lot of it ends up being sort of co-opted by many different kinds of structures, right? So I think historically in many countries, things like defense funding ending up getting much more of the slices of funding than other areas, or even kind of just looking at the US, the funding of general science just increasing very little decade over decade relative to the amount of technology that we've discovered in that time period. Great, so what are we gonna do about this? So the thinking that we've been doing is around network funds, and I wanna kind of start the story of this, and I'm gonna use this kind of like notebook structure to kind of like explore this with you and kind of talk about it in detail. I want to start the story talking about like, hey, there's some group of people that want to do some good work for the world. They want to produce some public good. And so they go on, they scrounge some resources, they start doing that good work, and they give it to the world. And they get something back out of that. They get the fact that they potentially achieved their objective. They had a goal and they achieved it. They usually will come up with their own reasons for why to create that public good. And they will go create that public good and they'll achieve that objective. Now, the fact that they improved the commons and so on doesn't usually get described here. So there's the world hasn't really come up with a good way, a good instrument for describing success in funding the commons in a way. That's another idea for another time. And I think things like impact certificates are start getting in that direction and so on. But there's some hard problems there around how we value things and how communities tend to value things and price things and so on. They're kind of difficult, and this is why we don't have good instruments for describing kind of you've done something good for the world. A lot of times this ends up kind of in the world of positive externalities. Ideally, they would not be externalities. Ideally, you'd be able to measure it so that you can then apply many other kinds of instruments and work and coordinate work. So sometimes, in addition to accomplishing the mission, these groups get the thanks of the people and the other organizations and so on around the world that are thankful for that work being done. And if you pile up a lot of thanks together, you can build a credit system. And so this is kind of like how many different kinds of institutions that produce public goods actually function. recognition and credit are a massive currency, and usually will be kind of different in each industry. But you can think of the whole academic establishment relying on academic credit as a currency, as a thing that you can aspire to and get, and in a sense sort of spend or trade in the scientific establishment across all of academia, across institutions and whatnot. Likewise, many different institutions raise funding from generous donors to do good works, and they usually credit them in some way. They thank them in newsletters, they thank them in public speeches, they thank them by putting their name on a building, and so on. So the kind of credit markets are actually quite large, and you can measure them in the many billions of dollars per year, probably tens of billions. That's a kind of an interesting estimation to make. How big are these credit markets? In a sense, part of the government funding agencies actually work with credit as well. They sort of getting successfully finding certain outcomes is a thing that they can use as a currency and as an item within their organizational structures. And this is actually where impact certificates can fit in. So you can think of that credit as something that you can bottle up, as we've heard in the past one in the comments, to create a certificate that matches that credit, and then can turn it into an instrument that could be bought, sold, fractionalized, and so on. This talks a lot about impact certificates, but impact certificates will feature quite a bit because they kind of come in to improve the picture quite a bit. So this is roughly the story for how an organization that is trying to do good works operates. And when they're fundraising, as I mentioned, you can kind of you can start like describing their environment in fundraising mode, where they kind of describe the goals that they're going to have. They describe the goals and missions that they're going to have, and they try to raise funding from funders, and they give thanks to those funders as well. They sort of like propagate the credit that the organization might get. And over time, these organizations raise more and more funding from funders and continue propagating the thanks and the credit along the way. Let's kind of take a moment to compare this to the startup VC funding world, because that's a super robust market, as I described, that has this kind of like very robust funding staircase in the middle. And let's kind of break down how this funding staircase has been built, how it got fleshed out over time, and what we can learn and how we can use that to build equivalent structures in the public funds world. Let's go away from the public funding world for a moment and just think about producing a product in a market. There's now a for-profit entity that some group of people that are banding together, forming a corporation to go and produce some product in the market. They're going to get that product and sell it to some party for some amount of money. And as long as this entity can continue getting enough money to produce a product and sell it into the market, it'll continue existing, it'll grow, and so on. Over time, it can sell that product to many parties. And if it's a successful business relative to other businesses, it can keep doing this, keep growing, keep accumulating a cash flow. You can sort of like, and of course, the customers are not just people in many cases, they can be organizations. So many organizations also buy products in markets and give money back to the business. Now, you can sort of like abstract out this entire set of interactions by kind of representing it as a market. The business produces some product, sends it out and sells it into the market and gets money back. And this tends to be generally pretty predictable. You can reason about the sizes of the markets. You can reason about how much it takes to build a product. You can think about how to turn this into a kind of predictable structure where you can start predicting what cash flow you will have based on a set of conservative assumptions about the market, the dynamics, how hard it is to build the thing, the competitive landscape, and so on. And so this is the world of business. The entire kind of capitalist world runs on this as kind of the basic unit of operation. And now what enables these entities and these structures to exist is that they can dream up this potential idea for some future cash flow, and they can turn around and raise money from investors to produce that valuable cash flow, and they sell some piece of that cash flow in the future, and that's represented as stock in the company or equity in the company, and that means a piece and a slice of that future cash flow, or a piece of the assets that the company holds. So in many cases, this cash flow might be unpredictable, or it might be or less predictable, or it might be volatile in some way, where like there might be bursts of returns and so on. And so there's some kind of balance sheet that emerges here in the company that gives it resources to kind of keep operating and eventually kind of distribute out to investors. So the traditional way in which corporations got formed initially was that people just wanted to pool their funding, try a lot of different risky endeavors, and then kind of return the kind of shared profits to the potential investors. It's kind of the traditional joint stock company that was formed in kind of the age of exploration, where people would send out ships for many months at a time, and it was actually quite unpredictable which ones would make it back. And so it was a way of pooling risk and pooling the rewards. And so another way of representing this, stock units in the corporation and whatnot is just a slice, right? So you can think of like getting a slice of the future cash flow here. Now, the markets that we have today are pretty robust, and there's all kinds of ways of like dealing with these assets. And there's large robust markets and so on for them, and there's a lot of different properties that you can imbue into these stocks. Sometimes it's very common, for example, to have preferred stock in corporations, and this is where investors get some additional rights encoded into the contract and whatnot. But part of what's made this a very robust market with a lot of participants is that there's only a sort of like relatively limited number of standard terms that people use, and it's standardizing on those standard terms that enables this to be a pretty large market with many participants able to take on a lot of transactions. The more kind of variation that you have in the terms, the more confusion that you have in these structures, or differences and so on, the harder it is for participants in this market to work. So this is what enabled things like standard equity investments with like a set of standard terms to emerge, things like the NVCA model, or even convertible debt structures, or the YC Safe. So the YC Safe was a really great instrument that got invented to kind of standardize a whole slew of different terms before to kind of arrive in some better market structure. So many times an innovation that just kind of looks at a marketplace and reduces the complexity of the decision of the transaction, so that many more participants can enter into those transactions, tend to be pretty effective. Let's keep exploring kind of what ends up happening with this kind of slice. So at the end of the day, what this slice represents in the long term is some right for potentially some dividends. So that means as a company makes profits, it'll distribute out dividends to the investors. This rarely happens today. This was much more common before, but there's all kinds of structural reasons that have prevented this from being the dominant. Another thing that could happen is that the company could be liquidated. So that means that it'll stop operations and it'll take whatever its assets are and distribute them out to the investors, the participants that have the shareholders, stockholders in the corporation. Or, for example, it could be acquired, right? So that means there's some other corporation that's going to come over and give money to all the existing shareholders for their stock units. So that now this corporation owns this other corporation. That usually is done to acquire the assets of the company in some way, or acquire the business and the cash flow. But so what this entire structure also enables the creation of a marketplace for stock units in corporations. So there's a lot of potential investors that could give money to many possible companies. And so that you can create sort of a robust market on this side. And you can actually create pretty successful businesses themselves doing this. And this is what kind of venture capital is, or just investment funds and whatnot. Now you can rely on markets too. You can think of this as a marketplace itself. And this is kind of what the stock markets are, and so on. But what's really interesting about this transaction is that it is composable. And I will kind of describe what I mean by that. First off, like it can happen in, sorry, before I get to composability, maybe I'll describe the stages. So it's very common in startups to have kind of like very early small amounts of money from angel investors, where like the company is much more risky, it's much smaller, the cash flow is less certain. And so these parties are investing early at a smaller valuation of the company, taking a much higher risk and getting some slice of the company. As the company proceeds and works harder and so on, and gets some certainty over the cash flow, it'll make this cash flow more certain, and it'll become suddenly more attractive to more institutional investors that maybe have more capital to give, but have higher requirements over the certainty of the outcome, right? So at the end of the day, they have some time horizon for these funds having the return on their investment, and the cash flow picture has to be relatively certain in order to kind of make this deal work. And there's some bunch of different kind of series of investments and whatnot, and eventually kind of there's some liquidity event. It could be an IPO. It could just be robust private markets. It could be dividend structures. It could be buybacks, share buybacks. Like the company could just trade part of its own assets for its stock back and so on. But the point is, like, there's some liquidity event that enables these early investors to profit from risking their capital to try and predict the future. So I tend to think of this entire operation, the kind of seed capital, Series A capital, and IPO markets, as a prediction market. It's a prediction market over what is likely to be a successful cash flow in the future. And so going back to kind of this picture, it's kind of a way of like trying to predict what's likely to generate a lot of value and betting on that today by using equity, and then have some time horizon over which you're going to bet. So now most modern VC structures tend to have kind of like a 5 to 10 year time horizon on this, but this could be much longer. So you could have some funds that invest in the 10 to 20 year time horizon. It's just kind of very like the return multiples have to look much higher in that case. Otherwise, kind of it's just rational to invest in shorter timescales. This is why this kind of triangle exists, because if the return timescales were much longer, you could afford to invest in harder science projects or kind of early technology and whatnot. So it's kind of the all of this is sort of related to how robust this market is, how many participants are there, what are the return multiples that you could potentially get, how predictable this is, how much risk are you taking on, and so on. So all of these features sort of explore this market. At the end of the day, though, the features of this structure enable another really, really useful component, which is composability. And let's dive into that. So when you look at kind of a VC and kind of think of it as a business, what it's doing is entering into a bunch of these transactions with startup companies. It is giving some cash at the beginning for a slice of the company as kind of like an initial part of the transaction. And later on, at another point in time, it's going to enter into another transaction, which is the reverse. So it's going to reverse this cash flow back. So the money is going to come back to the VC, and the equity is going to be shared back. And that happens in the same kind of structure as I was describing up here, where like there's some kind of dividend structure, liquidation, acquisition, and so on. It turns out that VCs can turn their business into a predictable cash flow itself. And VCs that have some guesses about the future can themselves not just have to put up their own money, but they can raise money from other investors. And this is usually traditionally done through a thing called like a GPLP structure, general partnership, limited partnership. There's a lot written about this online, so I won't go into details. What matters here is that you have basically the same transaction going on both ways. So a limited partner is going to provide some capital, some money to the VC for an exchange of some slice. Then this VC is going to do the same thing to a set of startups. And eventually later, there's going to be another transaction where this will liquidate back and provide some profits back. And then at that moment, the profits will flow back to the LP. Now, whether you do this all dynamically at once, or whether you do it in kind of iterative steps where maybe it collects a lot of money here and then later it distributes back and so on, there's a lot of variation in the world of funds, of kind of investment funds. And so that sort of yields many different kinds of structures, many different kind of funds and whatnot. But the composability of the structure here is the key piece that I want to kind of come back to. And another way of visualizing this is that a VC might have many LPs, many different LPs that have different sources of capital and whatnot. And the LPs themselves might have LPs. So this is part of what happened to create the funding staircase in the for-profit startup world, is that when it initially started as kind of like a 3-tier structure where there may be like some massive pension funds or large capital holders investing in one VC, which then invested in startups. So this kind of like is just like this version of the world. So like pension funds investing in VC. So this, imagine this being Sequoia or Kleiner Perkins or whatever. And then they themselves investing in startups, and just kind of a three-tier structure. Over time because this is composable, over time got fleshed out into much larger network. It's worth noting that like pension funds have their own layer of investors, which are like the individual stockholders. The point here is like this composability enables you to build arbitrarily sized networks here. You can build quite a large network over time, coupling all of these cash flows. And what you end up doing, and why would you kind of do this? Well, in reality, we're exploring a super high dimensional landscape. So what is likely to be a good business and so on is an information theoretic problem. It's an information search problem where you have to make a lot of guesses about the future in a highly dynamic system. And if you have some insight and some visibility into what's going to work and what's not going to work, then you have a profit-making opportunity, and that enables you to kind of hook into this system. And so what we've built over the last 30, 40 years with kind of the modern capital structures is a very deep network of funding investment structures that over time propagate signal on what is potentially a good cash flow. And the entire thing rests on the ability of these participants from knowing what's good and being able to profit from knowing what's good. Meaning this is usually done in a couple of ways, usually with the dominant form here is a thing called carry fees, which means that as the investment is flowing through, the particular fund is going to be able to charge a certain amount of the profits that are made. And also management fees, which are another fee structure, which is they just take some slice of the capital they're managing at any one point in time. But that's not very well incentive aligned, because management fees tend to be this kind of like, it's just too easy to kind of just keep sort of like spending management fees and so on without necessarily aligning with a good success. So leaning into carry enables this entire system to be incentive aligned across the layers of the network, and enables a pretty robust optimization over time. So if these startups are successful, and so very successful, like meaning multiples on return, it will return on investment with many times over, then all of these participants will profit, and the whole network all the way to the back, where there's like the least amount of signal, will profit from that endeavor. And along the way, you have all these sort of like cuts being made by participants where they had either visibility into some space, they had some knowledge about what was likely to work, or they just managed things better. So there's a lot. Oftentimes, it's about how well are you executing, how well are you managing the system, and so on. Or it could be about access. Sometimes it's about not just knowing what's likely to be good, but doing the work to talk to the companies and figure out how to invest in them and so on. So the entire VC landscape is about kind of producing this pretty robust network. It's no accident that looks a lot like a neural network. So if we kind of like replace these structures by these like neurons in the system, and you have kind of like the startups at the end, which are qualitatively different. We're building sort of like this neural network in a sense, with a system that is like feeding forward cash and then back propagating cash later. So and the key part of this is that the two assets that are being traded here are both kind of fungible. At the end of the day, equity interest can be priced in cash, and the cash is supposed to be fungible within the operation of this network. Just to kind of like reinforce that point, let me kind of show what a neural network looks like, feeding forward and back propagating. So a neural network is a way to kind of over time get a set of nodes in a system to learn something about the environment, and you do this by kind of feeding forward training data and then back propagating error, and over time optimizing to what like the right weights are here. Now it's not a perfect analogy. Like exactly what's going on in this process is not the same thing as what's going on in this process. But at a meta point, what this is doing is enabling these entities to kind of like optimize the high dimensional landscape. You can think of like some very complex dynamic environment where all kinds of things are happening, and these things are changing real time, with billions of participants around the planet doing tons of things. And you want to be able to kind of, as a system, integrate the signal and have a very robust view into not only what it looks like now, but what it's going to look like a year from now, 5 years from now, 10 years from now, and so on. So the kind of like in a big way, like the successes of capitalist structures are enabling this kind of like predictive models of the future to try and do resource allocation. And if you fail, like if you're not a very good manager, if you're not making good bets and so on, you'll decrease how much capital you have over time and fail out of the system. And so the whole thing is kind of like incentive aligned to predict certain outcomes. But the problem though is, again, this only works on a certain time scale. Like it doesn't, or rather, it's not that it only works on a certain time scale, is that in practice, given the amount of capital there is in the world, the amount of products there are in the world, what people tend to spend their money on and so on, it just has yielded an environment where most kind of capital structures end up, it is way cheaper for them to invest in things that are gonna just maximize some cash flow in the market, no matter almost what that is, relative to what kind of like humans actually value or what's good for humans long term, and so on. So there's some kind of like what this system does not have is the ability to sort of encode values and kind of maximize for them. So what do we need to do to get to a similar kind of structure in the public goods space? Like that's kind of where this kind of project is headed. It's kind of trying to figure out how to produce a kind of like robust optimization landscape like this one, but in the network fund, in the kind of public funding sort of world. And so I think that the missing unit that we don't have, the thing that's missing from this funding staircase, is that we don't have the idea of an organization that is going to be the kind of unit here in this neural network, the thing that's going to connect the kind of end sort of funders over here with the parties that are producing the public goods, and be part of an optimization landscape that's going to enable these parties to, over time, kind of, if they're doing successful work, increase their amount of funding so they can deploy better, or if they're doing a bad job, relative to kind of what their funders think and so on, then decrease the amount of funding or eventually die out. And so it's building a very robust structure here that is kind of what we're after. Now, going back to this structure, one of the key components of this composability is that this transaction in both directions is basically fungible. It's not quite fungible because stock here is not the same as stock here and whatnot, but it's fungible enough and similar enough that you can kind of price it at each point and kind of make the transaction very simple forward. Like this LP over here doesn't need to know the particulars about the startup here. And so the signal doesn't have to propagate all the way. It's just the benefits of the signal that are propagating. So how might we do this? Like the problem, if we could kind of go back to this structure, the problem is that we don't quite have some fungible thing that we can propagate back. So the good works, either accomplish mission. Credit is somewhat fungible, but not quite. I mean, at the end of the day, the way that credit is given is by naming people in thanks and so on. Oh, but wait, didn't we talk about a thing like that? We did, impact certificates. So it turns out that I think that impact certificates are the missing piece here. If you can use impact certificates, which in a sense is like a slice of the credit of this work, then we can potentially use impact certificates in this network structure to feed forward cash and back propagate impact certificates. And so this enables us to potentially create a composable framework by which you can create these network funds and propagate cash flow in one direction and back propagate credit for having built the thing. Now, that's a guess. We don't have to kind of couple these two innovations necessarily, but I think that that's something extremely promising, where if we can figure out impact certificates here and back propagate them through this network, then we have what we need to create a pretty robust optimization framework, and we can get to kind of really fill out this funding staircase. Now, so what are we doing in kind of a short term? So I think like the important piece is to flesh out and figure out impact certificates and build them out and build those out as systems. And B, we have to experiment a lot with network funding structures. So I think impact certificates are too early to kind of bet the farm, so to speak, on them. And so I think like we can start with network funding structures that are maybe shallow, where maybe you can propagate signal enough to the funders to know that that's good and a useful source of capital. A useful spend of capital. So that means, the shallower this network is, the more you can actually appeal directly to the funders and say, hey, we're trying to accomplish this mission. Hey, this is the kind of work we're doing. And that'll make sense, and funders will allocate funding. So what this would mean is that in the short term, we can create not just kind of like grant making groups, but groups that grant money to groups that grant money. And a couple of properties that are important here is that, one, you have a way to evaluate the success of each one of these groups so that they can report success up the network, and so that these funders can decide whether or not to deploy capital through this. So, a thing that we're going to be experimenting with at PL is to structure some of these funds. So we'll have one large fund that will be a funder of other smaller funds, where we'll start experimenting with giving kind of capital to capital allocators to invest in doing good works and doing producing public goods for a particular network. One important thing that I should mention here is that public is kind of like this very fuzzy word, where in reality, you can model this as a network and say you can usually create public goods with respect to a network, and that becomes a much easier problem because it's much easier to decide that you should deploy your resources in some commons that's associated with the people that are gonna benefit from the commons. And that's very easy to do in a network like Filecoin or Ethereum or Protocol Labs and so on. And so we'll start deploying a lot of our grant structures and start doing a lot of our development work structured like this. And so at the beginning, we'll start with shallow networks where we won't quite have impact certificates yet and so on, and we'll just kind of propagate in maybe 2 or 3 tiers. But the goal is to, over time, grow this and produce a much larger and much more robust network, and really get to a point where you can have sort of like funders deep, far away from the works, being able to fund network funders along the way and benefit from that work. And I do think that the impact certificates are a great tool here, that if we can get those working, they can enable these networks to actually get quite deep, and we can kind of create a much more robust structure like this. I think this implies that the impact certificates will need to kind of embody certain properties that will enable these funders to kind of decide certain things about them. And of course, the validity and verification of impact certificates will be critical to enable this to work, because if you're pretty far away from the picture, this is what enables kind of like bad information to pass through and kind of mismanagement of capital and whatnot. So if we can make the impact certificates verifiable, then this whole network can work dramatically better. I'll point out like a couple of similarities here. You can think of the S process as a kind of like grouping here, where you have some funders funding another tier of recommenders that are then funding some agencies, and you can kind of like draw a big circle around that and treat that as one fund. You can play around with coupling all of these mechanisms and all of these instruments kind of in similar ways. If you're interested in becoming a funder for this kind of work, we're going to be looking for kind of like fund managers in a sense. And one important piece here, I think it is absolutely critical that the fund managers here can profit from their activity. That is what will produce, that will draw super brilliant people to to compete with each other and work hard to spot better and better opportunities to fund public goods better. So the profit could be carry. Ideally, the key thing is to find some way to align the incentives and have some kind of carry structure that allows kind of the bets to then propagate back in results. And I do think that impact certificates might be a good way to do it. So not only so one option is to kind of profit in cash wise, but like that's what makes this really difficult, and it sort of creates conflicts of interest and whatnot. But impact if everybody's operating on impact certificates, then that might actually work. So this is kind of like work to do for the future. And I was going to mention that like we are going to be looking for weave our grant programs and our impact evaluator structure and so on into these kind of network funds over time. So stay tuned for more experiments in that direction. Thanks so much.